Hello, guys. Welcome to lesson 2 of the financial reporting. We were talking about the group account and we talked about some items. So, we were to start from the key adjustments of the group accounts. And to be specific, we shall talk about these adjustments that you can see here. So, we have the annualized profit on stock, we have the annualized profit on fixed asset, we have the intergroup owings, and we can also have uh, intergroup sales, though intergroup sales leads to the the annualized profit on closing stock. So when we shall be talking about intergroup sales, where one company sells goods to the other company, then we shall this one might lead to the aspect of annualized profit in case the company that bought the good were not able to sell all the goods at the end of the year. So meaning the items which are already in the store, the company that bought the goods did not manage to realize the profits, and therefore we have the unrealized profit by the other company. But the company which sold, if the parent company sold goods on all the goods to to the subsidiary, then the parent will realize all the profit. But the subsidiary, if they did not sell all the goods by the end of the year, it means that the amount that is left in the store, they are yet to realize this profit, and therefore this profit that is not realized must be eliminated. Also, the intergroup sales must be eliminated. You can also have the transfer of asset, transfer of fixed asset, transfer of fixed asset. Now remember, transfer of fixed assets. So a company, so the parent company may transfer asset on profit to the subsidiary, or they can sell. Another word we can substitute here, transfer, is to sell. They can sell fixed asset to a subsidiary on profit. But remember, fixed assets are not sold for resale. You need to know that one. So when a company acquire assets, they are not acquiring those assets for resale because it's very hard to sell the assets. So they are acquiring the asset for the purpose of the business. And therefore, the company that is selling the asset has managed to realize profit on that asset. But the company that has bought that asset, even if they bought it with the profit that they have already paid the company that was selling, it means that they have not realized that profit, and therefore it leads to what we call the unrealized profit. So transfer of asset leads to the unrealized profit on fixed assets, and therefore it must be eliminated. So all these items must be eliminated. This one must be eliminated. This one, this one, this one. Also, intergroup always must be eliminated. This is revaluation. So we need to check on revaluation. Revaluation will also lead to other items. Goodwill, we need to know how to compute them. Then this one we shall check here: post acquisition, dividend, and pre-acquisition. Pre-acquisition. When you talk about all these items, then the adjustment will be over. So when we shall be talking about intergroup sales, we shall link it with analyzed profit on closing stock. When we shall be talking about transfer of fixed asset, we shall link it with number 2, analyzed profit on fixed asset. Then intergroup always on its own. So this one we might link it with cash in transit. Cash in transit at some point. This is where the company, one company had took goods on credit, and then by the end of the financial year they had paid, but the amount was not received by the other company. So there is a cash hanging somewhere. They call it the cash transit. We shall also check on that, and at some point also we shall also look at goods in transit. Goods in transit. This one shall affect the inventory account. So meaning, one company bought a goods from another company, but at the end of the year, the goods were not received. They were received after the financial year. They were received after the financial year. Now, we need to adjust. Even if they were received after the financial year, we need to adjust it in the financial year that we are preparing, even if they were received after the financial year. So that's what we mean good in transit. So good has not yet been received, or they have been received after the after the end of financial year. So all these key adjustments, you can find them in your additional information. So these are the additional information that you are going to talk about. So I hope it will be okay. So that is number one, the intergroup balance or the intergroup indebtedness, or we call it the intergroup owings. So this occurs where one company owns another entity. So this mostly occurs where a company owns each entity. For example, we have the parent company could have sold goods to S on credit. So by the end of the year, S has not paid P the goods. Now that is an owing. Or S could have sold goods to P. By the end of the year, the parent company has not settled the amount that they received on credit from S. So either way, either side, those debt must be eliminated upon full consolidation. Reason why? Uh, because during consolidation, both entities P and S will be consolidated to act as one, and therefore we need to eliminate the debt because they cannot one entity cannot pay its debt. So, for example, Safaricom cannot repay. So, if Safaricom give loan to Safaricom, how do you settle that one? You just eliminate it because it's the same company. It is from one pocket to another pocket, but the same person. So, meaning upon consolidation, because when you're consolidating, we are making it a one entity, it means any owings that was there must be eliminated. And how do we eliminate that one? So we need to debit payables. We debit payables account. When we mean we debit payables account, it means we need to reduce the amount of owings from the payables account. So we less the payables account. That was we mean. Then we credit receivables account. What do you mean when we say we credit receivables account? It also means we deduct. So when we debit a liability, we deduct. When we credit an asset, we deduct. So you need to know that. So you need to know that one. So when we so you need to know this one. Let me put you. Let me give put it somewhere here. NB. Just this one is for at least you are for you to remember. So when we credit, when we credit, when we credit asset, we we mean minus, and then when we debit liabilities, we mean minus, and the opposite is the same. That one is fine. I think that one is okay. That is number one. So intergroup debt must be eliminated upon consolidation. They must be eliminated upon consolidation. Now, another reason why we are saying that these intergroup balances or the debts must be eliminated is also because since after consolidation, the parent will take everything and share uh, some to the minority. Intercompany debt uh, not settled must be eliminated. Must be eliminated. So they must be eliminated. Let's go to number two, intergroup sales. Intergroup sales. So intergroup sales, as you can see there. Now for intergroup sales, we shall combine it with unrealized profit uh, on stock, the UPS. Now in this case, we talk about intergroup sales occurs when one company sells goods to another entity. So the parent company may sell goods to S at a profit, or the subsidiary might sell goods to parent at a profit. Now, the company that is selling will realize the profit because they are selling and they receive the cash. Now, but the company that has received that good, remember they are buying the goods also for resale. Now, but maybe as the financial year end, you find that they were not managed to sell all the goods that they bought. Now, some goods were already in the store. So, meaning all those goods that are still in the store that were not sold by the year end, the company did not realize profit from those goods. Now, those goods that the company did not realize profit from is what leads to unrealized profit on stock. Now, intergroup sales and unrealized profit on stock must be eliminated during the full consideration. So, how do we eliminate them? This is how we eliminate. So, we start by number one, intergroup sales. So, the working for intergroup sales. So, intergroup sales. Now, intergroup sales means we debit sales. Debit sales. When we debit sale, it means we deduct the amount from the sales. It means we deduct. Then we credit cost of sales. Cost of sales. So when we credit cost of sales, it means we also deduct. So when we debit, we deduct, and also the other one we deduct. So it must be deducted from the two items. So when you debit sales, it means we deduct. But when we say we credit sales, when we say credit sales, we mean we add. But the opposite. So when we debit sales, it means we deduct sales by that figure. When you credit cost of sales, it also mean we reduce cost of sales by that figure. But when we debit cost of sales, it means we add. So in this case, we are going to deduct. Then we have the unrealized profit. Unrealized profit. Unrealized profit on stock. We call it the UPS. So the unrealized profit on stock, unrealized profit on stock. So we say we debit income statement. We debit income statement. Then we debit the non-controlling interest, NCI, with its share. So this one is the full amount. With full amount. With its share. Its shares. Then we credit inventory. Inventory with full amount. With full amount. So we credit the inventory with full amount. So this is the unrealized profit UPS made by subsidiary. Made by subsidiary. If it was subsidiary that sold goods. That sold goods. Now let us see unrealized profit made by unrealized profit made by parent company. So you can either have either. So you can either have between where the parent sells goods to the subsidiary or the subsidiary. So we debit the income statement with full amount. We debit income statement with full amount. Income statement with full amount. And then we credit the inventory with full amount. Credit the inventory with full amount. We credit the inventory. We credit the inventory with full amount. That is UPS. That is UPS. That is UPS. So when we credit inventory because it's an asset, it means we minus. This one means we minus. And also this one, it means we minus. And then when we say we debit income statement with the full amount, That is for the UPS, it means we add them back. So it means we add them back. So this one means, but this one, let it not worry you, because I will show you another way to maneuver, but it is fine. So it is fine. The important thing is you know which accounts are being affected. So that's all about the intergroup sales. So when you talk about unrealized profit made by the subsidiary, this is called the upstream sales. Upstream sale. Now upstream sales means uh, when we have, for example, the parent company selling goods to a subsidiary, then you have the NCI 20%. Now when we move from subsidiary and we sell goods to P, so that's an upstream sale. So where the subsidiary sells goods to the parent, then we have a downstream sale. This occurs where the parent is the one which is making the sale. So the parent sells now. This now is the opposite. So now the parent sells go to the subsidiary at a profit. So at a profit. So that's number 2. I think we can progress to number. So when you talk about intergroup sales, remember we have combined it with unrealized profit. The first one, intergroup balances. That one we have talked about something to do with cash in transit, which must be adjusted before eliminating. So in an exam, you check if there was any cash in transit. Number 3, we can move to another item, intercompany sale. So let us go to intercompany sale of non-current asset with UPFA. So intercompany sale or fixed asset or transfer of fixed asset. Now, before even we continue, we need to know how to compute the UPS. And this is how you get the UPS, annualized profit on stock. UPS. So I had forgot about that one. So it is equals to unsold goods. So goods that were never unsold. Unsold goods times profit margin times profit margin. So unsold goods times profit margin. Now, what if you don't have the profit margin but you have the markup? Now, how do you convert markup to margin? So remember, when you talk about profit margin, it has a big base. You can talk about the big base, or you can use anything that is big. Now, so let us say profit markup, markup to margin, to profit margin. Now, if it is A over B, then it will be equal to A over A plus B. So you add the numerator to the denominator. If it is, for example, 25%, this means it's 25 over 100. So how do you convert this one? It will be equal to 25 over 100 plus 25. If it is 1 over 4, for example, it will be equal to 1 over 4 plus 1. So you add the numerator to the denominator. So this one will be equal to 1 over 6. And the markup, this one will be equal to 25 over 125. This one is fine. Now, that's how you get the profit margin if you have the markup. Now, sometimes they can give you cost. Sometimes they can give you cost of goods. They give you the selling price of goods. And then from that information, you need to determine your markup, and at the same time, you also need to determine what we call what we call the UPS. Now we have another formula for UPS. So UPS will be equal to unsold good times, now our markup in this case will be equal to it will be equal to selling price. So not selling price, profit over selling price, over selling price. You know how to get the profit? Now profit is equal to selling price minus cost of the goods, or whichever way you can get the profit, make sure you get it. So whichever way you get the profit, please make sure you get the profits. Please make sure you get the profits. Now that one being said, I think now we can go to the next item. Can go to the next item, and that item is intergroup intergroup uh, transfer of fixed asset and the annualized profit from fixed asset. So that is it in our board. So intergroup sales, intergroup sale of fixed asset refers to the sale of fixed asset from one entity to another. The entity selling receives the annualized profit. So when I talk about the UPFA, I mean the annualized profit on fixed asset. So the entity that sells the asset, the entity that sells the asset will realize the UPFA, but the entity receiving will not realize the profits on the sale of fixed asset. The reason why, because the entity receiving is not meant to receive the asset. So the asset is there to be used for the business, and therefore in that case, one entity will realize the profit, but the other one will not realize the profit. Now in that case, uh, the intergroup sales must be eliminated. Intergroup sales and UPFA must be eliminated. It must be eliminated. And how do you eliminate them? And how do you eliminate them? Now we also need to know this one before even we continue. It's important. When an asset is sold by a group member, when an asset is sold by a group member, when the asset is sold by the group member to the other member, to the other member, the company selling, the entity selling realizes and realize profit on fixed asset, while the company buying makes depreciation overcharge, makes depreciation overcharge, make depreciation overcharge, makes depreciation overcharge. So what is this depreciation overcharge? Now depreciation overcharge is a situation where the business record more depreciation expense than it should during a given financial or accounting period. That is what we mean by the word depreciation. Depreciation overcharge. So this is the situation. This is the situation where the entity records more depreciation than it should in a given financial year, financial or accounting period. So a situation where the company records more depreciation than it should in a given financial year. So in short, it means that we have overstated our depreciation expense. That means the depreciation has been overstated. Now, before even we do, we let us show the workings of how to get the depreciation overcharge. So how do we calculate the depreciation overcharge? Very important. Now, depreciation overcharge is equals to what? How do we get it? Depreciation overcharge. It will be equal to the annualized profit on fixed asset times the depreciation rate. It will be equal to the annualized profit on fixed asset, the UPFA, we multiply the depreciation rate. Or it can be the annualized profit on fixed asset we divide with the number of the useful life or the economic life. Number of economic life. Now let us see how to eliminate this item. We start with number one, where the asset has been sold by the parent to subsidiary. Where the asset, so number one, where the asset has been sold by parent to subsidiary. Now, when the asset is sold by the parent to the subsidiary, the parent will make the unrealized profit, but the subsidiary will make the depreciation overcharge. So you need to know that one. You need to know that in this case, the parent realized profit on sale of fixed assets, while the subsidiary makes depreciation overcharge. So let us see the entries. We debit the income statement. We debit the income statement. And sometimes when I say we debit the income statement, sometimes I mean cost of sales with full amount. Yeah, when I say debit the income statement, I mean it is the cost of sales. It is the cost of sales. So we debit the income statement. Then we create non-current account, or the PP. We create the PP account with full amount. That's number one. So when so this one is for with the URP made by the parent. This one is for with the URP. with the UIP unrealized profit on fixed asset made by the parent. Then we have another one where so this one you be very keen. So you have another one here. So the first one is where the parent has realized the profit. Now, what about with the depreciation overcharge in the subsidiary? So this one with debit and current asset, the PPE account with full amount, then we credit the income statement, with parent share, then we also credit the NCI with its share. So we credit the NCI with its share. So that is all about where the asset is sold by the parent to the subsidiary. Now let us see in the case where now the subsidiary sold the goods to the parent. So where the subsidiary sold the assets to the parent. So how do we do about it? So let us check. So when we talk about the unrealized profit on fixed assets, this is how you are supposed to get it actually. This is the formula. So don't worry about this entry so much. We shall do them in a question so that you understand. So the UPFA is the transfer value minus the profit margin. So for you to get the UPFA, the annualized profit on fixed asset, you take the transfer value, then you multiply it with the profit margin. So you multiply it with the profit margin. I think that one is fine. That is all about the UPFA, the intergroup sales of fixed assets. There is nothing more or less to add on it. That one will mark the end of the third one. We can go to the fourth one. I think it is the fair value adjustments. The fair value adjustments. Let me see. Fair value adjustment. Where is it? Fair value adjustments. Just a moment. So the fair value measurement number 4. So the fair value measurement, this is the revaluation. So this occurs when the parent company revalue the assets of the subsidiary as at the date of acquisition. That is very important. Now, for you to get the revaluation, you take the fair value, you deduct the carrying amount. And we have the formula here. So you can either use the fair value minus the carrying amount or the market value minus the book value. So the fair value is also called the market value. The carrying amount is called the book value. Now, revaluation is what we call the depreciation under charge. So we'll talk about the fair value adjustment revaluation. We need to talk about the depreciation under charge. Remember, for the intergroup sales, it relates to depreciation overcharge. So this one we said it relates to what we call the depreciation overcharge. This one relates to what we call the depreciation undercharge, which leads to profit overstatement and asset understatement. Now, the depreciation undercharge is equal to the revaluation divided by the number of useful life. Or take the revaluation multiplied with the tax rate, but depreciation rate times the depreciation rate. That is the formula. Now, with the revaluation, we debit the PPE as usual. So when you say we debit the PPE, it means we add. So when we revalue our asset, our PPE must increase. Then we credit the revaluation reserve account. Then with depreciation under charge, we debit the income statement with the parent share. Then we credit the NCI with its share, and also we credit the PPE. So the PPE with full amount. So it will reduce the PPE account. So remember, it also reduces the depreciation under charge. We also will reduce the PPE account. That is all about the fair value adjustments. So that is all about the fair value adjustment. I think I have explained everything. The only thing that is remaining is the goodwill and the dividends. The goodwill, let me see. The rest we can do it in a question actually, because it does not require a lot of items. I think we can do them in a question when we do a question from a past paper. Also, the goodwill I would prefer we do it in a question. So, but for goodwill, the goodwill can be measured either using the full method or the partial method. So when we use the full method, it means that the goodwill is stated. So the NCI is stated at its fair value. But when the NCI is not stated at its fair value, then we cannot use that method. We use the partial method. For dividend paid by subsidiary, that one we shall look with a question. And the goodwill, we shall also look for those one with a question. So I think when we meet in our next class, we shall meet to do a question. We shall meet to do a question. Or maybe I can find another class first before we do a question. Maybe we explain all the other items. So, but for now, or let us try and do goodwill, computation of goodwill. I think that one will be important. We can do goodwill for now. Then we see if we can do dividends. Then we shall do the rest in our. We shall do a question in the next class. So we shall continue from that point. So we shall start with the goodwill, then dividends, then we come up with a format. So for now we call it an end. So we shall meet for lesson 3. We continue.